Well, in Finstry today, we have with us Mr. Keki Mistry, who needs no introduction at all. He has been the former Vice Chairman and CEO of erstwhile HDFC Limited, now Independent Director and Strategic Advisors at various firms. Welcome to the show, sir. To begin by asking you, deposit growth has lagged loan growth since 8th of April 2022. Loan growth has outpaced deposit growth since then. So over the last 2.5 years, loan growth has actually outpaced. So which should be the worrying factor going ahead, deposits or loan growth being at a higher pace?
All right. So before I get specifically into your question, I'd like to talk a little bit about the Indian economy. I think our economy is on extremely strong footing. Now, in an economy as strong as ours is, demand for credit will always be there. So there will always be continuous demand for credit. So we have to make sure that there is enough liquidity, enough money available in the system to be able to support that kind of growth potential that exists. Now, coming to your question of loan growth versus deposit growth, what used to happen historically in India, if you look at pre-COVID days, is particularly in the smaller towns, people were not very accustomed to looking at equity markets or looking at alternate places of investment. If you had money with you, the first thing you would go to would be to a nearby bank and deposit your money as a deposit. Then came COVID, and with COVID, everyone started having smartphones, everyone started becoming digitally more and more savvy, and therefore people today have access to information, even in the smallest of towns, have access to information on what is happening in the rest of the country. And people are now seeing that there are so many alternate investment avenues and not just bank deposits. So this is, to my mind, personal opinion, one of the reasons why you've seen a diversification of money which otherwise would have gone into bank deposits, now going into insurance companies, asset management companies, equity, and so on and so forth. And therefore, these markets have done extremely well. If you see equity markets in recent times have been boosted largely by domestic investment. Not that much by foreign investment, it's more domestic investment. And even today, if you look at the total funds under management, retail funds under management in equity, it is much lower in percentage terms than most of the other countries. So therefore, the potential to grow there is huge. So I think it's a changing phenomenon of habits of people. These things keep happening from time to time. What I explained to you was more a fundamental reason. But the fact of the matter is that at some point of time, deposits will again become more attractive, equity may become a little less attractive, so you will have these phases up and down. This is one reason for the lack of the slowness in liquidity. The other is also that RBI has been keeping liquidity relatively tight. You've seen a reasonably long period of time when there was a shortage of liquidity in the system, almost a 2 trillion rupee shortage, which is now gradually coming down. So there is more and more liquidity, more liquidity today than was the case a month ago. You're clearly seeing that. RBI's primarily concern has to be inflation. I think RBI has done a phenomenal job. Just as the government has done a terrific job, RBI has also done a phenomenal job in terms of not having the kind of tearaway inflation in India that we saw in the Western world. You see what's happened to the US, you see what's happening in various countries in Europe, and you see what is happening even in some countries in Southeast Asia. Tearaway inflation, unbearable inflation. We did not see that. And we did not see that because we did not go overboard in terms of pumping money into the system at the time of COVID. We kept a very clear view on what the fiscal deficit is. So RBI is concerned about, or would probably be concerned about inflation. They would not want inflation to go beyond a certain level. They gradually brought it down from 7.5% to about 5% now, and pretty much under control. Core inflation is less than 4%. I think it's around 3.8%. So my sense is once RBI gets a reasonable sense on where the monsoons are headed, whether monsoon will have reasonably normal monsoons and therefore we will not see any spike in food prices, I think that is a time when RBI will start infusing even more liquidity into the system. That will also be post-elections. So I think it's a short-term phenomenon when liquidity will be tight. Liquidity will get better and better, in my opinion, in the coming days. The worst of shortage of liquidity is behind us. And unless there is some new event which happens, which today we are not aware of, I think the liquidity position in the system will keep getting better and better.
Well, loan growth in unsecured portfolio has actually caught the eye of RBI. RBI has been cautioning lenders against unsecured lending. And also, I did a story with respect to credit deposit ratio being mandated by RBI at around 75% to many lenders. So, do you see RBI getting cautious with respect to, robust loan growth in the unsecured segment, or the risky nature of loans that have been built by the financial services sector
See,
in the
my
recent times?
interaction with various companies, and I speak to many, many companies, not just banks, but even NBFCs. I'm strategic advisor to Poonawalla FinCorp. So, various companies. There is nothing that I've heard from any one of them where they pointed towards any real concern on unsecured loans in terms of asset quality. And that is because the economy is doing very well. And as long as the economy is doing well, people will have the resources to be able to pay back the loan. So credit risk is very, very limited. RBI has been extremely proactive. And I said that before, all compliments to RBI. They started seeing that the growth of unsecured loans was at a level which made them a little uncomfortable. And that is the reason why I think it was in November, they increased the risk weight on unsecured loans from 100 to 125%. Effectively, it is to some extent make unsecured loans a little more expensive in the books of the lender, because you have to provide more capital when you do an unsecured loan. But it is more a precautionary thing. It is not that there is any real concern that has emerged in the market. And at the moment, I have not heard anyone in the market talk of any real concern on credit. Credit is at its all-time best. The level of NPLs in the system, NBFCs plus banks, is probably at its lowest it's been ever since I started working more than 40 years ago.
By when can we see rate cuts coming from RBI? When do you feel government can actually reduce their cash balance with RBI and boost the growth in the
We
economy?
have seen a little bit of the cash balance with RBI, government's cash balance with RBI come down. It's not been a significant decrease, but there has been a decrease in recent times. Look, my sense is once RBI is comfortable that the monsoons are reasonably normal, and there is no spike in oil prices because of some geopolitical event which we are today not envisaging, I think that is the time RBI will start looking at rate cuts. So I do believe that in the second half of the calendar year, we could start seeing some kind of rate cut happening in the system. What is important is not just rate cut. What is important is just liquidity in the system. And as I explained to you, liquidity, to my mind, in the second half of the year will be better than it was in the first half. And with every passing month, I think the liquidity situation in the system will keep improving. Unless there is some event which happens which makes RBI more cautious.
Well, RBI has been cautious and taking action against some lenders or some NBFCs per se. What is the regulator's discomfort that you feel that has actually caused them to take such actions?
Well, it has to be looked at in specific reference to any particular company, so I would not be able to comment on that because I'm not associated with any company where RBI has put any regulation. But I think RBI, and rightly so, as a regulator, has to be very cautious.
Very proactive.
And proactive. And therefore, if they are seeing that there is some concern which is emerging, whether it's on KYC, it's on something else, then RBI will immediately step in and intervene in the market, which is the right thing to do.
Well, post-elections, do you expect banking sector's credit to corporates to pick up or demand from corporates
I would think
being
so, yes.
sanctioned and disbursed to corporates?
It has been a long time that we've been talking of the fact that corporate credit offtake has been slow. I do believe that the post-elections, you should see a pickup in corporate credit offtake. You see, the more, this is very important to understand this, that the more the jobs you create, the more people have income. More people earn income. The more people that earn income, with the money they have, they go and spend that money. So consumption improves, consumption increases. When consumption increases, the manufacturer of that product has to produce more to satisfy the demand. Because he has to produce more, he may have to borrow money, install more capacity, create another factory or another unit, produce more of that product, which means hiring more people. When you're hiring more people, again, you're paying more salary. So it's a way the economy keeps revolving. And today, India is on a very, very, very strong footing.
Do you feel the need for more players in the financial services sector?
No, I think there are enough players in the financial services sector.
Okay.
I think there'll be some amount of M&A that may happen in the system, but that is a normal thing. And I don't think there's anything abnormal. The risks, what are the risks? The risks are monsoons, climate-related issues, and the second risk to my mind is oil. We are largely dependent for global supply of oil. So theoretically, for some geopolitical event, which we cannot envisage today, if oil prices were to shoot up, then all these assumptions that we are making could change.
Well, thank you so much for your time,
Not
Mr.
at all.
Keki
My
Mistry.
pleasure. Thank you.
That's a word coming in from Mr. Keki Mistry that the outlook for Indian sector, especially in the financial services sector, remains robust.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.